All right, welcome back. How's everybody doing? Hope you're doing okay. We're kind of getting down on the home stretch. We're moving on to residual income valuation. Hope you're feeling quite unhappy because, like I said before, inverse relationship to your happiness factor and your probability of passing. So think about, keep your eye on the prize. We're going to get there. Here we go. Residual income. So residual income, this is one of the kind of pillars here for equity evaluation. While you're looking at it, make sure that you really focus in on this area, given that it's one of those more highly tested areas. It's one of those pieces, just like free cash flow. You know it's going to be there. You're kind of going to need these points. So make sure that you understand the concept. You know how to kind of get there. It's not too bad. All right. So the concept of residual income basically has to do with traditional financial statements essentially are prepared to reflect earnings, just earnings in general, whereas net income basically includes things such as interest and represents the cost of debt, capital, basically interest expense. Other things such as dividends for equity capital is not explicitly deducted out there. And GAAP accounting leaves equity owners basically the task of determining whether the earnings that they get actually exceeds the cost of their equity capital. And more kind of a simplistic standpoint to think about it is, so a company can actually make money. They have earnings. They even pay, let's say, a dividend. But the question becomes is, how much additional earnings are you actually giving me over a fair return? So there is an overall required or cost of equity return. How much are you giving me in addition to that? So, for instance, a company can consistently have earnings and keep giving me 1% return, but guess what? My cost of equity capital is greater than that. So while the earnings itself is showing a positive number, I'm, as an investor, faced with the task to say, is that number exceeding my cost of equity? And this is kind of where residual income kind of focuses in. So residual income is very closely linked to other valuation models. So the first one being the present value of growth opportunities. Notice your EPS over the required rate of return plus any additional present value of future growth opportunities out there, right? And what we're looking at, because this is very similar to what? Notice in the numerator is what you're going to earn. In the denominator is what you're required to return, right? And we also saw in price to book, remember in previous classes we wrote ROE minus G and then required rate of return minus G. And then so notice that over the fraction, the required return on equity, what I'm earning from this particular investment over essentially the required rate of return on equity. What is a fair return on this? So in this case, these types of fractions, I want these to be greater than 1. So, and the 5 forces model, Michael Porter's 5 forces and competitive strategies, basically link to if they have a competitive advantage or if within the Porter's 5 forces they are giving me additional return than what is fair return associated with that particular equity. So, defining residual income. Residual income is essentially equivalent to economic profit. So it is net income minus the cost of equity capital, or what is the fair return of that equity capital. And accounting income will overstate returns from the equity investor's perspective because it ignores this cost of equity. They may be overzealous that, hey, I made money, but you didn't make me more money than what's a fair return for that particular investment. And residual income explicitly deducts all capital costs, both debt and equity. So you're supposed, per the cost of this debt and equity, you're supposed to return that much. What, in addition to that, are you actually giving the investor? So looking at residual income, what we're doing, we're using a post-leveraged figure. You have net income, which notice includes essentially the interest already, so it includes interest expense, so it's post-leverage, minus equity capital times cost of equity. Notice this is how much equity capital is in there and times the cost of equity. Alternatively, you can also use a pre-leverage figure where you subtract, you remove the interest portion and then put back the tax and then subtract out the cost of essentially total capital. Notice I'm using weighted average cost of capital, which includes what? The cost of debt and the cost of equity, or if there are preferreds, it would also include that. And recall this does it on a weighted average basis, right? The equation for weighted average cost of capital. Let's jump forward. So residual income calculation, let's go through an example. You'll see my earnings per share, my book value per share, and my equity return. So let's just dissect some of these numbers here. An equity return of 10%, this is what I like to think about. This is my fair return, right? This is what you should be giving me, this 10%. Now, if you're giving me anything more than that 10%, that's residual income. Keep in mind, just by the definition of residual means what? What's left over? What's an addition? What is the remainder, right? After you've paid me my 10%. And then here's my book value per share. This is how much I'm giving you. This is what it's worth. And then this is what you're actually earning. So let's take a look on how this kind of example works. So if I want to calculate residual income, it's essentially earnings per share minus book value per share of the previous period. Because keep in mind, when you earn return, you're earning what you put in the money at the beginning of the period, and the return is what happens at the end of the period. So the way I like to think about it is earnings per share minus what I call a fair return, right? And so earnings per share, just so we're clear here, I can also calculate earnings per share what? By book value per share at t minus 1, meaning the previous period, times what? How do I get from book value per share to essentially earnings per share? I multiply by return on equity. This gets me my first number. And then the fair return is my book value per share at t minus 1. And I multiply that by my required rate of return on equity. When I net these two, this then becomes my residual income. Let's say residual income per share. So in this example, we had 1.2 as our number. And then we had $1 here, which is our $10 times the 0.1 here. And then when I subtract the two, I get to 0.2, which is this 20 cents here. So this firm has earned a positive residual income of 20 cents, providing additional value for both debt and equity holders. So you're giving me, in addition to that 10%, that I should already be getting as a fair return. So there's some alternative residual income measures, most notably economic value added, which is a very similar in concept. It basically measures the value added to shareholders essentially by management. Notice it is net operating profit after taxes minus the weighted average cost of capital of the entire invested capital. Notice this is net operating profit after taxes is your EBIT 1 minus the tax rate. Notice I've removed the impact of interest and put back the tax. We've actually seen, if I put this up here, we saw that equation a couple slides ago. Now, positive economic value added means management is actually adding value over the cost of capital. If there's negative economic value added, they're actually adding no value. And so what you should do is then evaluate the relative change of economic value added over time, meaning how much is management actually adding value to the shareholders. So alternative residual income measures, there's also market value added, which measures the effect of value of management's decision since the firm's inception, so since the beginning. So market value added is the market value of the firm over the difference between that and the invested capital, meaning what is in addition to what I put in. So a company producing positive market value added will have an excess market value over its book value because it essentially has created what? More returns over the fair return. And what you should do is then see what is the change in the market value added over time. Meaning, keep in mind, this is since inception, because it's almost like a balance sheet number where I'm looking at what is the firm, what's the market value of the firm, and then how much money it was actually put in. So have they generated additional return over the invested capital and versus the cost of that capital? Because if this is actually negative, then what ends up happening, the market of the firm may actually be less than essentially the invested capital, since they're actually losing money. Just think about that concept a little bit, because if I am raising through debt, there's invested capital inside the company. It has to pay interest expense. And if you're earning income or revenue that is essentially less than the interest, then while that money is there, it's decreasing the market value of the firm and not creating positive market value added. So let's take a look at some uses of residual income, some common uses. Big one, like we've stated in the last two slides, just evaluating how what is management's effectiveness, right? And then also to determine what executive compensation. So, but for the exam, we're mostly interested in equity valuation. In fact, this entire exam is mostly interested in just basically valuation in general. So let's take a look at the intrinsic value and residual income. So residual income approach basically is the value equals a value of a particular equity is equal to its book value plus the present value of anything you're giving me in addition to my fair return, or the future residual income, right? So notice I start with book value, and then I discount back all of the future residual income to find a value, okay? This is very, very important to kind of think about the concept. Notice I'm saying that the value of the firm is essentially its invested capital. So we put in this much money, here's the book value. This is the value of the firm. Anything you're giving me over that, I'll add that to the value. Now, remember things such as the dividend discount model, free cash flow. The majority of the value was actually on the back end at this terminal value. I was looking at the cash flows into the future and assuming, let's say I sell the stock 10 years from now, and then I discount the value, what I think, let's say 10 years from now that stock would be, and I discount it back to today. Notice it's backloaded. In the case with residual income, what differs, one of the main differences is that the value, majority of the value of the firm is front-loaded, very, very much in the front, using book value and just adding in addition to book value. So how do we calculate future residual income? I know this formula looks scary. It's actually not that bad. It's just a little bit of work with some practice. It should be pretty second nature to you, and we'll kind of go through this process. So the idea is that you're looking at current book value of equity, book value at time 0, plus any present value of expected returns of future residual income, right? So notice I have book value, and here is the present value of all of the future residual income. And keep in mind, residual income is the earnings minus what? The required return times the book value of the previous period. This formula right here we've seen before. It's the same thing. EPS, right, of the next period times what? A fair return, right? And this equals to my residual income. You got to have this nailed down. That's tier 1 formula, meaning something that should either you memorize it or tattoo it to the small of your back. I don't care. But it's definitely something that you need to know. Keep in mind your fair return, what is book value per share at time 0, or if you're further down, it's T minus 1, right? Times the required rate return is essentially my fair return, right? And earnings per share, like we saw on the previous slide, is ROE times my book value per share, let's say at time 0 if we're right there in the beginning. Let's take a look in further detail here. So there's two methods for calculating residual income. This is the method that we just showed. And then notice I can take ROE and just subtract it by the fair return. You'll notice if I multiply multiply the book value into here, it equals the equation up here. Because ROE times book value t minus 1 is what? EPS, right? So it's the same equation. The question is how you actually want to do it. I typically, if possible, I kind of stick with the top one because it's a very simple EPS times minus a fair return gets me to my residual income, and I know how to calculate these. These each have their components, book value per share, whether by ROE for EPS, fair return, required rate of return on equity. Or I do it this way, ROE minus R times book value per share. You can do it both ways. It'll get you the same answer. Then you discount each of those back. This is your residual income into the future. Add that on top of the book value. Notice that is where the value is actually dominated. And since it's at time 0, it's not really affected by what? This R, because I'm not actually discounting essentially majority of the value of the firm. Okay, so before we jump into an example, let's just kind of go through the process. Look, residual income, I don't think is from a calculation standpoint, it's not difficult. I would say more or less it's just a little tedious. All right, it's a kind of a two-step process, which I'll kind of go through and how I think about it. The first step you're going to need to do is calculate book value per share. All right, so after you calculated all the book value per shares, the next step is then you're going to have to calculate each of the residual incomes. After you've calculated all the residual incomes, then you're going to use those residual incomes and discount them back and then add them to the beginning book value. All right, so those are kind of the steps. So the first step, though, is getting all of the book value per shares, because remember, I need book value per share to calculate residual income. So let's start with book value per share. So typically it starts with book value per share at time 0. And you want to think about this kind of like an engine, right? And you don't even want to think about, it should almost be second nature to you on test day. You start with book value per share at time 0, right? And then the question becomes is how do I get to the book value per share for the next period, right? I would add the earnings per share at time in time 1 for the year, and then subtract out the dividend of the next period. This gets me to the book value per share at time 1. Now, I start the engine over again, and I start with book value per share sub 1, add in EPS sub 2, so earnings per share at time 2, dividend sub 2, and then this gets me to book value per share at time 2. And I do this over and over again, depending on how many times or how many years they're actually making me do. So notice it's an engine, right? It's like you just put this together, get all your book value per shares. Once you have the book value per shares, then these then help you calculate your residual income. Because remember, residual income equals what? EPS sub 1 minus a fair return equals your residual income at time 1. And we know that EPS sub 1 is book value per share at time 0 times ROE, and book value per share times 0 times the fair return. All right? This will help me get what? First residual income. I got that one. Then I basically bring in book value per share again to calculate EPS minus the fair return. I do it again. Book value per share at time 1 times the return on equity. I do book value per share at time 1 times my fair return. This gets me to what? My residual income at time 2. All right. Whew, I've gotten 2 of them now. Now, let's go for the third one. I use book value per share at time 2 times ROE. And then book value per share at time 2 times the required rate of return on equity. This gets me to my residual income at time 3. Notice I went from the top engine to calculate book value per share, then goes to the second engine and then calculates each of my residual incomes. Now remember what this is end up going to be is I have book value per share at time 0 plus the residual income time 1, residual income at time 2, residual income at time 3, and then I will discount each of these back. 1 plus r, 1 plus r squared, 1 plus r to the 3. So I take each of these values, bringing them in to basically find what? Price of the stock. Okay? Now, think of this as like just a process. All you're doing is just running the process. You should just be like a machine. All right? Think about it as like mining for Bitcoin, but manually doing it in your head. Okay, so you're going to go through this process and just start with your book value per share process, then go through the second engine to get your residual income, and then plug it into the appropriate equation. Now, we'll see some variations in the third step as we go further in the slides, but this engine is basically what, scares most candidates, but it's not really that scary if you really think about it. All you have to do is just do it a couple times, and it should be pretty good to go. And make sure that you understand kind of the general concept. Let's take a look at an example now. All right, so what we got is the required rate of return on equity in this example is 12%. Keep in mind that's R. That's going to help me kind of calculate what's kind of our fair return. And then what we have is book value per share at 3.4. This is my book value per share at time 0. And then I have each of my earnings per share for time 1, time 2, time 3. Now, in this example, they've been kind in that they've given me earnings per share. In some cases, they may make me calculate it. In this case, they may just give me return on equity. And remember, I would have to multiply the book value per shares that I've calculated times return on equity. Now, they've given me a payout ratio of 50%. Why do I need this payout ratio? Dividend. Because I need the dividend to run the book value per share engine, right? And this equals what? This equals my earnings per share, right, at any particular period, times 1 minus B, or what we call the payout ratio. This will get each of my dividend values. Notice what it says here, that the dividend in 2003 is a liquidating event. That means this 2003 $1.20, not only at the very end, there's going to be $1.20, it's going to pay out its entire book value per share as well. Now think about that just for a moment here. So if I have a liquidating event, I'm paying the $1.20 and I'm paying out all the remaining book value per share. That means book value per share goes to 0. That means moving forward, there are essentially no more residual income to essentially discount back, right? So let's take a look on how this works here. So what do we got? We got 2001, 2002, 2003. This is the top engine. Notice we have it nicely divided for you here. So I have book value per share, adding my EPS, subtracting out my dividend, and then I have my book value per share for the next period. Right? So in each of these, notice I now have, after I run the whole engine, I have all of the book value per shares. Notice also the liquidating event. The dividend per share in 2003 was the $1.20 plus the what? Plus the remaining book value per share. Notice the book value per share goes to 0, meaning into the future, if I was continuously running this engine, there essentially would be no more residual income. So here is my equity charge, or my fair return, right? I'm essentially going to take, notice, all my book value per shares that I basically calculated in the engine at the top, starting with the 3.4, because these are the 3 book value per shares I'm using. So the first one being 3.4 with a fair equity charge of 12%. That would get me to my first number of 0.41. This is my first fair return. Now, how do I get to residual income? I have a fair return of 0.41, 0.46, and 0.53. What did you give me? Here are my EPSs, right? What I do here is take my EPS here minus my fair return. So 90 cents in this one right here minus the 0.41, I get to what? 0.94. So this is my residual income at time 1, residual income at time 2, residual income at time 3. And you probably already can guess what we're going to do with these numbers now. I'm going to discount them back, and then add them to book value, and that essentially will get me to my intrinsic value. Let's take a look. So here is my book value at time 0. Notice this is my cash flow at time 0. I can essentially stick them into my calculator and type in each of the cash flows, put my required rate of return or cost of equity at 12% as the I, solve for net present value. That means that the equity today based off of residual income is 4.82. That's it, right? Not too difficult in the sense that if you get that engine and you just keep practicing and running, it's just a little bit of tedious kind of calculation as you go through. So looking at the differences in value recognition between residual income and discount cash flow, I touched upon some of this stuff earlier. So the value is recognized earlier, because why? It's so dominated right in the beginning by what? Book value at time 0. Then, under the discount cash flow model, and essentially it's less sensitive to terminal value estimates, because that terminal value in discount cash flow is all the way in the back, which gets discounted back to the present day. So, in book value at time 0, usually, like I said, represents the largest percentage of the intrinsic value, because the value of under residual income is book value adding on any present value of additional return. In dividend, discount, or free cash flow models, terminal values typically, that value all the way at the end that gets discounted to today, basically is subject to a substantial forecasting risk due to forecasting horizon and essentially the relationship of the required rate of return on equity and the growth rate, right? Because it's all the way in the back end, and that's basically when you're calculating that terminal value using, let's say, the Gordon growth model, R minus G, it really is dominated by those, and you're present valuing the very large, substantially large terminal value using that cost of equity. So, value drivers of residual income. The main point is, you want your return to be greater than the required return or fair return. This is the whole idea. You want residual income to be positive. You want the justified market to book to be greater than 1, meaning you want your market value of the stock to be greater than its book value, because that means it's generating additional return. So if the return on equity equals the required rate of return, the justified market value should be its book value. You're not giving me anything extra. And the market to book value ratio essentially would equal 1 as well. Okay, so taking a look at residual income valuation and justified price to book ratio relationships, residual income models can be used to establish basically market multiples such as price to book ratio based off of the forecasted ROE and earnings per share. So residual incomes are basically most closely related to justified price to book, because remember ROE being in the numerator and cost of equity in the denominator. Also Tobin-Hughes ratio, where you have the market value of the debt and equity over the replacement cost of the total assets. Think of it as far as in the numerator, it's very similar to market value added, where you have the market value of the debt and equity divided by the assets. Instead of using book value, we're using what? Replacement cost of the assets. So kind of using a market value approach to both the debt and equity as opposed to just the equity, as we see in a justified price to book. And then jumping down, when the present value of the expected future residual income is positive, the justified price to book is greater than 1, because why? The ROE, return on equity, in the numerator of the equation is going to be greater than the denominator where the cost of equity would be, creating a greater than 1 justified price to book. There's also the constant growth residual income. So in a single stage residual income assumes there is a constant ROE. So we'll just essentially divide by R minus G, and then here is my residual income, right? This is the same thing of what? EPS minus the fair return equals my residual income. Because why? ROE times book value per share is my EPS. Equity, the cost of equity times book value per share is my fair return. And doing both of those gets me to my residual income. Add it to the current book value. This is the value of the firm. All right, so let's take a look at an example of a single stage residual income. What we're looking at is North Pacific Whaling Company. I hope they don't make too much residual income. But anyways, let's just jump into this. So book value we got a book value of $37 for this thing. They have a return on equity of 23%. That's a lot of whales. Whereas their required rate of return is 18%. And then we have a dividend payout of 40%. All right? So think about this. What we got book value. We're going to need the book value per share to run the engine. We got return on equity. We got our required return for the fair return. And then we have our dividend payout to calculate our dividend. Okay? So let's start our little engine process here. If we get, we notice that ROE times B is the growth rate. So we have the return on equity was 23. Payout was basically 0.6. Oh, I'm sorry, the retention rate is 0.6 given a payout ratio of 40%. And we have a growth rate essentially of 13.8%. What we're doing here is R minus G. This gets us to our G. Now, our EPS was what? I had a book value of 37 times an ROE of 23%, right? And then I had a fair return with a book value of 37 times an 18% required rate of return on equity. When I do that, I get 1.85. This basically is this value over here. Notice just a different way to calculate it. I'm just trying to keep it in the context. It doesn't matter which way you want to do it, but you know, one or the other, it gets you the same answer. This whole numerator part, 1.85, and then I got my required rate of return on equity of 0.18, and then 0.138 as my growth rate that I calculated up front. Initial book value per share at time 0, 37. Add this to that value, I get to $81.05 for my whaling company. So, what about residual income versus price multiples and discounted cash flow? So, the whole point, in theory, all methodologies should lead to the same result, but this is not always in practice. So, price multiples, essentially residual income most related to price to book, right? We've seen why. If residual income is positive, the price to book essentially will be greater than 1 because the numerator where return on equity is going to be greater than the required rate of return in the denominator, right? Whereas dividend discount and free cash flow both involve discounting future benefits as well as that terminal value all the way at the end. Whereas residual income starts with kind of a base value and then just adds additional return over the fair return onto that book value. All right? And so dividend, discount, and free cash flow is just the present value of these relevant cash flows as opposed to an add-on to book value. All right, now let's take a look at continuing residual income. So expected residual income essentially beyond the estimated time horizon. What's residual income going to be in the long-term future? And depends on the firm's ability to generate return on equity over essentially its required rate of return on equity. And essentially it's related to Michael Porter's competitive advantage and Porter's 5 forces that we saw in study session 11. Don't be surprised to kind of see those parts of study session 11 combined with, let's say, a vignette here. And It also is industry structure, whether it's perfect competition. In industries where one company has a monopoly, more or less, in most cases, can generate that additional return on equity over the fair return, given its position in the market. How do we measure this kind of continuing residual income? It's measured through what we call a persistence factor, all right, which is denoted here. So, and it's going to be between 0 and 1. So just pause for a moment and kind of think about what this means. Is that over the long term, it's going to be really difficult for firms to be able to continue to make additional residual income and sustain that, because why? If you're making a huge amount of residual income, people other companies are going to come into that space, and they're going to get the competition within that space is going to get larger, unless, let's say, you're a monopoly, but then it's going to start to diminish the residual income of that firm. So you're looking for a higher persistence, meaning a longer period where ROE is going to be greater than its required return. So several things that suggest that you would have a higher persistence level. Low dividend payout, right? We also talked about this. Low dividend payout means what? The company's keeping the cash to do what? To reinvest that cash, right? They're not paying it out because even with high growth stocks, if they pay that dividend, right? They're like, hey, here's your money back. And so high residual income industry persistence. These in industries where they can continuously, historically have shown higher residual income persistence, and then factors that typically suggest a lower persistence level, meaning closer to 0. Things, companies with higher return on equity, it's harder to sustain that high return on equity. If they have large special items that are there, and then also basically large accruals. Right? Accrual accounting. So large accrual accounting, large amounts of accrual accounting, because why? This is all about persistent earnings. Empirical evidence has shown that companies with cash-based earnings tend to show more persistence. Accrual-based accounting, accrual earnings are shown less persistent, meaning they haven't gotten the cash yet for those earnings, and they've been accruing those earnings. So this suggests a lower persistence factor. So how does ROE converge, basically approach the required rate of return on equity? When the persistent factor basically lies between 0 and 1, and so the lower the persistence factor implies that it's quickly falling in continuing residual income, which results in what? A lower firm valuation. So think about this as that additional return is consistently falling. Now, if you have a higher persistence, it implies a slower falling continual residual income results in a higher firm valuation. Longer forecast periods results in a continuing residual income converging to 0. So keep in mind that as you look farther out, it's harder for a company to make that additional return. Like I said, more industry competitors come into that space, or they lose their competitive advantage. Things such as patents may expire. So these things are all things on why this residual income in the long term converged to 0. Continuing residual income. So possible approaches for continuing residual income. For residual income, they can essentially drop immediately to 0. There's no competitive advantage, right? This is a pure competition environment. You're selling, let's say, bottled water. You can't really give me additional return over a fair return just selling bottled water. It's pure competition. I guess there's some companies that may think they can do. I think there's a company called Voss that sells, I think it's like $8 a bottle of water. It's like one of those. I had it once. It's almost something you had to like drink with your pinky up while you're doing it. So, looking at this, so persistent at a current level. So another way this possible approach is they persist at a current level forever. This is a perpetual competitive advantage. So in this case, What are we talking about here is that, potentially a monopoly, they consistently have this competitive advantage, and it goes consistently forever. This is where you have your persistence factor equal to 1. Now, in many cases, they decline over time, so it's between 0 and 1. Or they decline not to 0, let's say, but let's say to a mature industry level. So looking at the multi-stage residual income model, the intrinsic value is essentially the sum of 3 components. The first component, like we said, is book value, which is still dominating. And then what we have is the present value of the residual income in the high growth period and the present value of our continuing residual income. So, first you calculate your book value, you calculate your residual income for, let's say, the first high growth period, and then your continuing residual income here. And you'll notice, how do we calculate that? We take our residual income divided by 1 plus R minus the persistence factor. All right? Let's take a look at these different approaches. Approach 1, let's say immediately it drops to 0. So what we do is we just take the residual income terminal 1 plus R. We're just discounting that one residual income. Now, approach 2 uses let's say, at a current level, they're going to have a continue persistence, continue residual income, and continue competitive advantage. So they will continue at that level forever. Think of a perpetuity. Notice it's minus 1 plus 1. Essentially, it's just residual income divided by the required rate of return. And then the third approach is if it declines slowly, where the persistence factor is between 0 and 1. So it's the present value of the residual income and 1 plus the required rate of return on equity minus the persistence factor. This basically is slowly declining to 0. And then in a mature industry, the market value essentially equals its book value plus present value of any residual income in the continuing residual income in the final year. And so how do we do this? We have the price at the terminal value minus the book value at terminal. So you'll notice I have what? Price of the stock minus the book value of the stock at terminal plus the residual income at terminal and discounting that value back. Think about this as kind of discounting that last value in this multi-stage residual income. Keep in mind, make sure that you're focusing on this last formula here, because this almost some people may mistaken that this is actually what? A terminal value. But notice what it's doing. It also subtracts out book value, right? So all that is left is essentially the residual income into the future, right? So keep in mind, because when I actually discount this back, I'm still going to have book value at the very, very beginning. So it's only discounting the price over its book value, and that's it. So there is no large terminal value sitting at the very, very end of your multi-stage residual income model.